Welcome to this presentation of the Irish Fiscal Advisory Council's Fiscal Assessment Report, Managing the Recovery. As background, the Fiscal Council is an official independent body with a mandate to assess the public finances. That covers assessing and endorsing the macroeconomic forecasts, assessing the budgetary forecasts, monitoring compliance with the fiscal rules, and assessing the overall fiscal stance. The December 2021 FAR provides an assessment of Budget 2022, published this October. Turning to the key messages. The economy is broadly continuing to recover. Pre-crisis levels of underlying activity were already reached in the second quarter of 2021, and growth since then has been quite strong. However, the recovery is uneven. Looking further ahead, the economy is expected to grow at around 3% in the medium term. One of the factors contributing to this growth are the government's investment plans, but there are risks here related to capacity constraints. Overall, risks around Budget 2022 are broadly balanced in terms of the upside and the potential downside risks. Budget 2022 forecasts a sharp narrowing of the deficit to just under 6% of GNI star in 2021. However, the deficit this year could ultimately be narrower due to higher revenue and underspends in some areas. This budget was based on the government's new medium-term framework set out in the summary economic statement. This is the first time a budget has been based on that framework, and that is welcome. It includes a spending rule that sets current spending to grow at potential, assumed to be around 5% a year, and that should lower the debt ratio by broadly balancing the budget. The medium-term forecasts are also based on the existing level of service and are more credible than forecasts in the past. This is a realistic set of budgetary projections. Furthermore, there's also been the new National Development Plan that updates capital spending plans to 2030. Although the new framework is welcome, there are areas that could be strengthened. In particular, departmental expenditure ceilings should be set out as legally required. The spending rule could also be linked more closely to the domestic fiscal rules, expanded to cover non-exchequer spending and tax changes, and given legislative backing. 2022, and consistent with this medium-term plan, the government stuck to its planned 4.7 billion budgetary package. This provides around 1.6 billion to maintain existing services, a further 1.5 billion in new current spending, and a further increase of 1.1 billion in government investment. As a result, the budget forecasts a deficit of 3.4% of GNI star for 2022, but it could be lower. Keeping to the planned package strikes an appropriate balance between supporting the economy and keeping the public finances on a sustainable path. For the medium term, the government needs to continue to follow through on its strategy. The plans would allow public investment to increase to record levels and maintain existing levels of service while improving the public finances. The budget would reach close to balance by 2023, and the debt ratio would fall to below 90% of national income by 2025. This would also comply with the domestic fiscal rules. However, it is unclear how major commitments on health and climate change fit into the government's medium-term strategy. The cost of Sláinte care has not been updated since 2017. There is no estimate of the budgetary cost of implementing the Climate Action Plan. And this is problematic because the medium-term plans only allow for an average 0.5 to 1.5 billion a year of additional current spending without raising taxes or cutting spending in other areas. So the picture is really very tight. Furthermore, the impact of aging and over-reliance on highly concentrated corporation tax receipts also needs to be addressed in the years ahead. Let me now turn to explain this in more detail. Beginning with the economic and budgetary outlook, the economy is continuing to recover. If we look at the left-hand chart, which is based on real spending on cards and through ATMs, we can see that that spending recovered in the early part of the year to the 2019 level, and more recently has gone far above that level and has pretty much reached the pre-pandemic trend. When we look at that on the right-hand side in terms of underlying domestic demand, we see a similar pattern with reaching the pre-pandemic level in the early part of the year. Further growth is anticipated. And we also see that in the longer run, though there is going to be some permanent cost of the COVID crisis, some shortfall relative to the pre-pandemic trend, it's much less than was observed and was forecast in the SPU. So on the whole, scarring is relatively limited, and we also have a relatively positive view of the medium term, with growth expected to be at around 3% on average over the medium term, which is not very different to what it was in the pre-pandemic period. But we also know that the recovery is uneven. So we know that the digital and the pharma sectors have really been performing very strongly over the past year, including during the pandemic. But we know that the services picture has been less good. And we know that the recovery has been uneven, even within the services sector. So this is based on cards data. It may be distorted a little bit by changing patterns of card use as people rely less on cash. We can see that some areas, such as restaurants and accommodation, haven't fully recovered to the pre-pandemic trend, but have performed relatively well. We can see there's a very big shortfall on transport on the left. Entertainment has picked up, though maybe some of that is sort of streaming services and things that aren't produced domestically. So we see there's quite a mixed picture across the sectors, and of course, within these sectors, there may be a wide variation between different businesses as well. One of the factors that's contributing to demand over the medium term is the increase in the high level of public investment. The NDP plans to raise public investment to around 5.5% of GNI star, which is essentially a record level. In a recent paper by Eddie Casey, Niall Conroy, and Elliot Jordan-Doak, for the recent analytical paper that you can find here, they estimated the impact we might expect this to have on the economy. We'd expect it to boost the level of potential by 2030 by about a percentage point. It would also increase inflation a bit, and of course, relative to a scenario where this money wasn't being spent, public debt would be higher. But all this new building and investment is going to require additional resources. The paper estimates that this would require an additional 30,000 construction workers over the coming years, and that's going to be very challenging. If you take the chart on the bottom right-hand side, you can see an estimate of the unemployment rate for the construction sector. These are workers who are unemployed but were previously in the construction sector. You see that was extremely low before the pandemic. And so there's going to be a very big demand for resources and quite limited supply. Migration in the past has played a big role here, but we know that Ireland has become less attractive as wages have gone up in people's home countries, as the cost of living here is high. And of course, the pandemic might have changed people's willingness to travel. So all of this could lead to higher prices and is a potential challenge to the government's plans in raising investment as much as they plan. Turning to the medium-term budget plans, taking a more fiscal perspective, Budget 22 forecasts a sharp narrowing of the deficit to 5.9% of GNI star this year. And that's because on the one hand, major taxes have recovered or outperformed. So here we see the seasonally adjusted level of monthly taxes. We can see that income tax is actually well above its pre-crisis trend. On the other hand, we can see VAT has not quite recovered to the pre-pandemic trend, but it is higher than it was pre-crisis. So there's been strong recovery on the tax side. And if we look on the spending side, most departments have underspent in 2021. We see this as the cumulative underspent that's been building up through the year, partly in the health area, but also partly in other areas. Some of this is because money that was maybe being held back as a contingency for COVID wasn't spent, but it does seem to be a slightly more generalized phenomenon as well. So if we take those two things together, the recent strong tax performance and the underspends, it may well be that the deficit is narrower than was expected on budget day. Looking to the medium term, the government's new medium term framework is welcome. This was set out in the SES, but this is the first budget that's been done using this approach. There are really three pillars to look at. The first is the new spending rule. This sets current spending to grow at potential, which is assumed to be around 5%. So this keeps the growth of spending on a steady path and should essentially help to maintain the budget balance. The second thing is that the medium-term forecasts are based on the existing level of service and are therefore more realistic and more credible. This is an area the Council has raised concerns about in the past. Up to April, the budgetary projections weren't based on taking into account what it would cost to maintain the existing level of public services and welfare payments. That's now changed, and so these medium-term forecasts provide a useful insight into budget developments over the coming years. And the third aspect is the new National Development Plan, which updates the capital plans to 2030. So overall, this is a big improvement. For 2022, and consistent with this plan, the government stuck to its planned 4.7 billion billion budgetary package. If we look at the different elements of that budgetary package, we see the first three elements, which is an allowance for demographics, for pay, and for maintaining the existing level of services. We see about 1.6 billion of that package was needed just to essentially maintain what the government already does. On top of that, there's an additional 1.1 billion increase in the level of capital investment, and there's about 1.5 billion in new spending. This is new current spending. This is spending on current spending to activities that weren't taking place. So it's an expansion of what the government does. There are also some tax measures, and that takes us to 4.7 billion. As a result, the budget forecasts a deficit of 3.4% of GNI staff for 2022. While there are risks obviously on both sides, it could well be lower given the recent strength of revenue. There are also around 4 billion euros of contingencies for COVID the government has made. If things don't work out too badly on the pandemic, it may well be that that money is not spent, and that would lead to a lower deficit on these figures. Keeping to the planned package for 2022 strikes the right balance, an appropriate balance between supporting the economy and keeping the public finances on a sustainable path. If you look on the left-hand chart, you can see the output gap. That's a measure of the shortfall of economic activity relative to what it could be. You can see that grew very sharply during the pandemic. Obviously, part of the economy was locked down, people were staying at home. We can see the economy's recovered very sharply, and so there's not much of an output gap at this point, and there's not much of a case for a general support, even next year, for the economy. If we look at what that means in terms of the general government balance, we can see that the general government balance is expected to recover very sharply as the result of us hopefully moving out of the pandemic, the economy recovering, and spending associated with the pandemic ending. That will basically leave the budget balance more or less where it was before the pandemic. I think it's also interesting to look at how quickly that recovery is compared to what we saw back after the banking crisis. It's been a very different shock. And so we've recovered much faster to roundabout balance. If you look at what that means for the public debt on the right, public debt is expected to peak this year at around 106% of national income. It's then, in gross terms, it's then expected to fall at a fairly steady pace over the coming years and to be around 90% of national income by 2025. That's still a very high level of debt, and it means that by 2025 we will have got back more or less to where we were before the crisis. So a lot of the work that's going to be done to reduce the debt for the next years is just going to be to take us back to where we were. And you can see that actually the path of reduction is shallower than it was in the pre-crisis period. These plans for 2022 and for the years beyond are supported by a number of factors. One is lower temporary spending. So you can see on the left-hand chart, this is temporary spending, most of which is COVID related. There's also some other things like the Brexit adjustment reserve. You can see there's a lot of spending in 2020, a bit less in 2021. You can see some of the contingencies that are built in for 2022, but that essentially is expected to fall away after 2023. In terms of permanent spending increases, if we look at this measure of net policy spending, you can see that while there was a big permanent increase in 2021, that was actually partly offsetting a pretty weak increase in 2020. And you can see there's actually a fairly modest pace of growth over this period, particularly in current spending. And of course, the one thing that is pushing up on spending is public investment. So if you look at these green bars on the right, in terms of the overall spending increases, they're accounting for quite a lot, even though it's still a relatively small component of overall government spending. One of the things that's been important since the SES is actually that the spending plans have been scaled back somewhat. In the SES, we were concerned, or at the SES time in the pre-budget statement, we were concerned that the plans the government had were really at the limit of what was prudent, and we felt that maybe they were trying to do too much. Now, if you look at these green bars that show the budget plans for the growth of net spending, if you compare those to the grey lines, which are what the SES has, you can see there's been a little bit of a scaling back. And I think that's a very prudent thing to have done. And I think it makes sure that we're not at the edge of what's appropriate. A big part of this whole picture is the very large increase in public spending, which is set to rise to very high levels. So if you look at the left-hand chart, you can see public spending in Ireland over a long period, the green line. You can see at the moment we're about the average. That's quite a big increase over where we were in the kind of post 2012, 2013. You can see that a big further increase is expected. Now it will essentially take us more or less to the record level, around 5.5% of national income. And one of the important things about the National Development Plan is it suggests that that very high level will be sustained all the way out to 2030. So this is a very major sustained increase, public spending, public investment effort. You can see on the right-hand side how those plans in successive fiscal plans have been ramped up by the government to take us to the red line. Again, actually, the SPU had slightly stronger numbers than this, but it's come back down a little bit, which is probably a sensible thing too. Now, this very large investment plan should help to address the major climate and housing issues that need to be addressed. However, more details are needed on the plans and their expected economic impact. And that's true of the National Development Plan. It's also true of Housing for All. There just aren't a huge number of numbers in those documents. There's a lack of detail, and there's not much analysis of how these are going to meet their objectives. And I think that would be very helpful in understanding the fiscal pressures in the years ahead. An interesting question is to look over a bit slightly longer period to try and understand how this major ramp up in public investment is being achieved without increasing borrowing or without raising taxes or very obvious offsets. So what we've done here is we've compared 2019 with 2025. So 2029. So this basically takes out the impact of the COVID crisis, because we're starting before and we're ending in 2025, when those effects should have, there won't be really, hopefully won't be COVID effects. Now, if you look at this change over this long period, there are a number of things that are kind of interesting in explaining how this ramp up in public investment is being achieved. So if you look on the bottom row in the change column, you can see that over this period, nominal national income is expected to increase by around 30%. So that's a pretty big increase, actually, a big cumulative increase in national income. And if you look in terms of revenue terms, revenue is expected to grow not quite as fast over that period, but actually most of the main tax heads, including income tax, corporation tax, VAT, are expected to grow a bit faster than that. There have been some sort of favorable underlying developments there. It's also that our work suggests that many of these things grow a little bit faster than the national income over time. So we see there's quite solid growth of revenues. I think the corporation tax number is quite interesting here. This already takes into account the effect of an expected decrease in corporation tax linked to international tax changes. But despite that, we still see that corporation tax is adding an extra 4 billion over this period. So there is a lot of money coming in from corporation tax, much of which is coming from the multinational sector. If you look on the spending side, spending is actually overall growing more or less at the same pace, but you see the public investment is growing at an average rate of 10% per year over this period. So it means overall public investment is almost doubling over this period. It's increasing by almost 7 billion. Some of that is being met by the fact that interest payments are falling over this period, but it's also coming from the fact that current spending isn't growing particularly fast relative to national income. So we see there's a number of factors, including growth, including taxes, including corporation tax, including interest, and also restraints on the current spending side, that's helping to achieve this big increase in public investment without taking too much risk with the public finances. And so for the medium term, we think the strategy is appropriate, and now the challenge is for the government to follow through on that strategy. If they follow this plan, the budget would reach close to balance by 2023. The gross debt ratio would fall to below 90% of national income by 2025, and this would comply with the fiscal rules. And as this chart shows, the plan in budget 2022 is pretty close to estimates of the sustainable path. And that wasn't true early in the year, so this is another improvement. However, and I think it's very important, it's unclear how some major commitments the government has fit into the government's medium-term strategy. And these include the Climate Change Action Plan and Sláintseachtaí. And if we look at the chart on the right, this underlines how tight the pressures are on the public finances. If you take each of these bars, this is the total amount of current spending increase that the government is planning each year. So it's around 3 billion. But if you take those lighter bars working from the bottom, that's how much the government has allocated to maintaining existing level of services in the budget. So most of that additional money is actually going to be used to pay for things the government is already doing, but they're going to become more expensive as the population ages and because of pay increases and inflation. Now, if you factor in as well those sort of medium green bars, which is the council's estimate of what it would fully cost to maintain existing level of services, you're left with the dark green bars, which is the remaining space for core current spending. That's how much new government core spending can be achieved without raising taxes or cutting spending in other areas. And that average is only 0.5 billion, 500 million a year. That's very little space for the government to be meeting some of the sort of potentially very big costs related to the Climate Action Plan and Slauncher Care. If you take the two bits at the top, so if you look at what the government's actually allocated, there's a bit more space. There's 1.5 billion a year. But if you did that, in the council's view, you would probably be actually cutting existing services in some way. So the council's not taking a view as to whether those things are desirable or not. It just shows that there is very little space for the government to increase current spending in the years ahead without raising taxes or cutting spending in other areas. And these pressures from climate and from Slauncher Care are very significant. In terms of climate change costs, these may very significantly impact the public finances. This shows the proposed emissions reductions by sector by 2023 relative to 2018 from the Climate Action Plan. You see big reductions in some areas, not quite as much, but each area is going to have to make very big adjustments. And there is currently no estimate of the budgetary cost of implementing the Climate Action Plan. And we think this needs to be addressed as a matter of priority. Many of these needs are probably investment needs and could well be met as part of the National Development Plan. So some of these costs have been built in, but particularly on the current side, it's very unclear where the money is going to come from to implement this and how much it's going to cost. So this is a major issue that needs to be addressed. The other area where more clarity is urgently needed is on health costs. So we know that the cost of healthcare has been rising over recent years quite fast. We also know that budgeting has been poor. There's been a history of overruns, of poor predictions of what particularly hospital care would cost, and then massive overruns. And this is explained very nicely in this new analytical note by Eddie Casey and Killian Carroll that the council put out last week. I recommend that you read. But more immediately, the cost of Slauncher Care reforms hasn't been updated since an estimate made in 2017. It's not very clear how that estimate was made or exactly what it captures. And though the government has said what it will spend on health for 2022, there's no indication of how much that will be afterwards. If we look on the left-hand side, the bar compares the estimates of spending so far, the green bars, with what the Slauncher Care estimates originally put in, so that's 28 billion. And we can see there's only a gap of 700 million. Now, our impression is that the Slauncher Care reforms are not as progressed as far as that, and that would suggest that there are big risks of additional pressures here. And the government really needs to set out how much it now thinks Slauncher Care is going to cost, how much of that's been spent already, and what it expects to need to spend in the years ahead. Turning back to the budgetary framework, so that both the policy but also the general approach, the framework is welcomed, but there are some areas that it could be strengthened. Now, this table we've shown before, it's a kind of checklist of the government's progress in various aspects of the budgetary framework. The bars, if you read them from left to right, show how much progress there's been. The hatched bars, the sort of shaded ones, show how much progress there's been since the SPU in April. And you can see the government really has significantly strengthened the overall fiscal framework. It's particularly the spending projections are now much more realistic. The commitment to medium-term objectives and various other measures are all very welcome. But there are a number of weaknesses too. So this table points particularly to weaknesses around the non-exchequer, forecasts other parts of government beyond the Exchequer and also the Rainy Day Fund. But even in terms of the things that they've done, there are 3 areas that can be improved. One is linking the new 5% spending rule more closely to the domestic fiscal rules. And there are some somewhat technical issues about the way the 2 are constructed. That means they're not consistent at the moment. It should also be expanded to cover non-Exchequer spending, which is a big area that needs to be made more transparent, and also tax changes to make sure that it builds up a kind of holistic picture of the public finances. And thirdly, giving legislative backing would strengthen this framework significantly. In the past, we've had a number of initiatives where the government has committed to some sort of spending or some sort of fiscal rule, and then it's sort of sunk without trace in the following years. So I think it is important to give it that prominence, and also to work out some of the design issues and clarify what it really means. One of those areas in particular that we highlight is departmental expenditure ceilings. So for a number of years now, there's been a commitment that the government should set out for each department an expenditure ceiling for 3 years ahead. Now, this is supposed to be a medium-term ceiling, but in the past, the government hasn't done it on a realistic basis. And so we've ended up with what you see in the chart here, which is that every year, the ceilings just get revised up. And while they should be providing an anchor for departmental spending, they're actually just drifting, and the exercise really lacks meaning. However, now that the government has put in place a realistic headline figure with the 5% rule, it would make a lot of sense to set out in departmental terms what they expect to spend in each area for the years ahead. I mean, health would be a very good example of this. Really, given Slauncher Care, given the 5%, it would be just incredibly helpful for the government to set out what it actually thinks it's going to spend on health over the next 3 years. And there is actually a legal requirement to do this. In recent years, up to recent years, the government did publish this on budget day. Last year they didn't. This year they didn't. And I think this is a very strong supporting measure of their spending rule, and it's hard to understand why they haven't applied it fully on this occasion. Finally, there are 2 other long-term issues that are important for the public finances that the government needs to bear in mind. One is demographic aging and the impact that has on pensions. So in the last couple of months, we've had the report of the Pensions Commission. What the Pension Commission proposes does address the long-term sustainability of the pension system. If the government were to implement this, it would essentially deal with the long-run sustainability of the pension system. So this is a very useful contribution. What's needed now is for the government to commit to implementation of the pension reform. Ireland has a long history of having many reports on pensions, but ultimately not delivering. And so the government really needs to say what it's going to do in response to what the Pensions Commission has set out. And you can see on the right the preferred reform package recommended by the Pensions Commission and how the savings that it would deliver at each additional horizon. About 40% of this comes from linking the retirement age to life expectancy. Most of the rest comes from a significant increase in PRSI contributions, and some of the rest comes from the Exchequer and some other moves. One issue that is, I think, important to think about is that both on the tax side, where it's not very clear exactly what timing the Pensions Commission has in mind, and in the fact that they are delaying raising the life pension age to 2028, this does raise a question about the credibility of these reforms. Will future governments want to, when the time comes, actually want to increase the pension age or increase taxes quite substantially? We know from recent experience that's not always the case. And so I think there is a big question about the credibility of this. And of course, delaying reform always ultimately increases the costs as well. One particular area might be to think about phasing in the PRSI increases over a longer period, beginning earlier, to make sure that it's done in a smooth and credible way and that it isn't delayed for too long. This other long-term issue that also remains to be addressed is over-reliance on corporation tax receipts. This chart shows that corporation tax as a share of Exchequer tax revenue. We can see it's at around 20% at the moment. That's 1 in 5 euros is coming from corporation tax of Exchequer receipts. Now we know that as a result of the international tax reforms, The Department of Finance estimates that around 2 billion will be lost in revenues due to reforms to the tax base. So that's what draws that line down a little bit. But of course, the plans to raise the revenue rate, raise the headline rate to 15% in 2023 could raise very substantial revenues and could actually avoid at least a good part of that decline in the share. And of course, this is a concern because we know these revenues are potentially volatile. They're very concentrated in a small number of international firms. 10 firms last year accounted for more than half of the total revenue. Many of those firms have done very well lately, but of course, this is subject both to how those firms perform and also to what happens in other international, other jurisdictions in the tax system. So this is a real vulnerability for the public finances, and it's running at a very high level, which I think is the concern of the council. In the council's view, any additional increases in receipts should be saved in the rainy day fund, and there should be a longer term effort to reduce over-reliance on corporation tax. In the report this time, we draw the parallels with the Norwegian oil fund. There's a lot more money involved in the Norwegian oil fund, but it is a way of reducing their reliance on volatile receipts, of saving money for the future and avoiding a steep fiscal adjustment if this money were to disappear over a relatively short period of time. So let me end with the key messages. The economy is continuing to recover. Budget 2022 forecasts a sharp narrowing of the deficit this year to just under 6% of national income. The government's medium-term framework is welcomed. It could be strengthened in some ways. For 2022, the government stuck to its planned 4.7 billion budgetary package, which was appropriate. For the medium term, the government needs to follow through on its strategy. However, it's unclear how major commitments on health and climate change fit into that strategy. Of course, there are long-running issues with the aging of the population and over-reliance in corporation tax. Thank you very much for listening, and I look forward to your questions.